All right, so we're going to talk about institutional staking and the TradFi path to DeFi. Yeah, great topic. Would love to get started. Just a quick round of introductions. Everyone, maybe just say just one sentence, two sentences, what you're doing and how are you involved with institutional staking. Yeah.
Great. Thank you, Mirko. Thank you, everybody, for coming. Well, I'm CTO and co-founder of Sensei Node. We are the first institutional staking provider in Latin America. Funnily enough, like 98% of our customers are not in Latin America, but it is, of course, our hope that in 2-3 years' time, when institutions in Latin America get more developed and they start doing also staking, we're going to be there and with a track record of doing it internationally.
So my name is Julian Butulu, CEO and founder of Stake Capital. Been in the space for a very long time. I'm the founder also on Rec News. Probably you guys have been looking at the website. We cover a lot of different vulnerabilities. And also asset management. We have invested in more than 200 different projects. And we've also been building a couple of different DeFi unicorn in the space.
I'm Will Shannon. I'm the head of node operator mechanisms and a contributor to the Lido DAO. So we're the part of the DAO that's responsible for coordination with node operators and very much involved on the product side for things like ST Vaults, which is part of Lido v3 going live in the next few weeks, which will be very relevant to the discussion from the Lido side in terms of institutional staking.
Awesome. Very quick to myself. I'm Mirko, co-founder and CEO of Staking Rewards. We operate the stakerewards.com platform. We do ratings on staking providers and soon on DeFi protocols as well. We host events for staking and on-chain yield, and we're also building yield products that deliver above market average returns. It's kind of interesting, like looking at institutional staking now, it seems like there's a very big traction, especially in the US. There's a lot of headwind and so on. There's like all the ETFs launching, everyone is looking into staking. Why is that happening now? Like we already had Ethereum was like also like there was a big Ethereum run up in 2021 already, and like staking was there also. Like why is the big kind of institutional adoption of staking just happening now, and why is it happening now? So from your perspective, why does TradFi care now, but they didn't do before?
Yeah, so I think they probably did actually care before, and increasingly have been getting comfortable with the asset class in general. Like I think the big obvious unlock here is just like regulatory clarity and regulatory change, right? So in the US, I think it started like very much with like the Bitcoin ETFs being approved. Like there started to be a lot more noise and interest from that perspective. Obviously, in the last like year and a half or so, right? Like there was a change of administration in the US that has become very much more pro crypto, pro Web3, more around like open markets and probably challenging some of the like entrenched incumbents in the US and the differences that this space like potentially like caused towards their businesses. I think from like a staking perspective, it's very, very clear that there are benefits for folks that want to hold Ethereum or other like tokens that have staking. Like not being staked is a like implicit like loss of funds, right, in terms of returns. And so there is like clear need if you're going to hold these assets in most cases to be staked. But yeah, I think regulatory is the big change and unlock here.
All right. So it's really like regulatory clarity that enables staking now. Yeah. Yeah. Do you want to add to that?
No, I think when you see something happening now, usually, when you see it, it's already been years in the making. For those of us that have been in crypto for a long time, I think the US has been very smart and very strategical when they started like accepting crypto in general. I think, in 2015, we were all talking about China and look at what China was doing with the miners and so on. But when China started banning Bitcoin and persecuting miners and crypto entrepreneurs, I think the US was very good and strategical at taking like the center ground for crypto. And obviously there is a lot more regulatory clarity, but I think that was going to happen anyways, and the plan has been in the making for quite a while now, and we just taking the benefits now, reaping the benefits now.
I have a different analysis in the market. I mean, the technology has been there for 15 years, becoming more mature, more integration, technology become more robust. So imagine you have people that start their career at 20 years old and now they have 35 or 40. They were born in that type of digital world, tokenization, tokens, crypto, Bitcoin. So by the time they get to uh, tier one or tier two of the enterprise, then they also want to push those different products because they potentially have holdings, potentially have family, son, kids that are utilizing this technology. Um, so I don't believe that Bitcoin or Ethereum or those different networks were actually in capacity to support traditional finance. 'Cause traditional finance is extremely sophisticated and advanced. We usually underestimate how complicated is traditional finance. It's not someone day one from 0 to 1 came up with, oh, let's do finance that way. It took ages. It took like 100 years. And in order for decentralized finance to replace or to advance that type of technology requires a number of years. And this is the situation where we are arriving, is the ability for that technology to support a new change in traditional markets.
Yeah, I mean, it's a new technology. It's a very complicated stack, and that's also that's the question. What do institutions actually care about? What are they looking for from your perspective? When they come to you and ask for staking, like what's most important? Because obviously it's not just yield, it's like usually it's much more, and you need to build relations, and like there need to be trust and tooling and so on. So what is like the most important thing that institutions are looking for, and what does it take to onboard them actually?
Yeah, I think in crypto in general, it has become more professional. Before, protocols years ago, like the first validators and the first miners, they were like unknown. You didn't know who you were delegating to and so on. So I think institutions, they mainly want to know who is on the other side, right? They want to have a company that is registered. They want you to be SOC 2 compliant, ISO 27001 compliant. So they take safety and security first, and I think they prefer that to like taking bigger risk and maybe making 2-3% more APY. So I think for us at least, when you talk to big institutions, they do a lot of due diligence on your processes and the security measures that you have in place.
Well, I think I believe institutions are looking to consolidate their market shares. So, and that's the problem I think with this industry or this ecosystem is people believing that because the technology is better, the institution will adopt. If institutions see a better technology but something that will reduce their market shares, then they will not adopt it. It's a game, it's a competition. So institution will only adopt the technology if they actually can increase their market shares, can reduce their cost, can increase their P&L and ARR, and that's what is extremely important. And then if they understand that the technology will come and take some of their market shares, they will start investing. That's why it takes times, because they will make pitches and conferences about, oh, this is a bad technology, this is not going to go anywhere, we believe it's bullshit and all different things. This is not that actually they believe in that. They're telling you this because they want to slow down until they actually can adopt and make good acquisition of very good looking company. Like if you look at big institutions like JP Morgan, Morgan Stanley, whatever, they start criticizing, start stopping it, and now they start adopting it and pushing for better tool, like acquisition of bridge, acquisition of big companies. This is what they're doing. So institutions were looking at stability, reinforcing of market shares, and then they can help maybe flourish startups and people that are building good technology. But they will not do it if it actually goes against their interest.
Yeah, I think like the only thing I'd probably add to what you both said is like institutions like cannot face total loss, right? Like that's a very different thing in crypto where like you can be completely blown up to zero, and in TradFi like it happens, but it's much more rare. There's a lot more protection, and so on the staking side, like I think there's a good amount of due diligence around making sure you don't get slashed and making sure you don't go through like serious significant penalties. And so institutional providers like want to make sure that they're working with very well experienced node operators that have infrastructure redundancy, that have a track record. The certifications you mentioned are definitely helpful in terms of signaling that you're a professional. like they actually really don't show much in terms of how well you know how to run validators. But it's something that's like in terms of a credential, like gives them some level of comfort. So I think avoiding slashing, just in addition to everything else that was said.
And what do you think is holding institutions back? Like, is it like what type of risk is holding them back, or even perceived risk? This can be different as well. Like what they think is risky, or what is actually risky that holds them back.
Yeah, I guess like it sort of depends. So, and the conversations have shifted, right? Like from years ago when it was very focused on like we don't know if MEV is legal, to we see a lot less of those kind of questions when we talk to clients now. Like now a lot of the focus is around like how assets are held and custody. Like custody is a huge factor, and especially depending on jurisdiction. And when you're talking about like smart contracts, like the way Lido works, they really need to have a deep understanding of the protocol and spend hours and hours and hours trying to understand how like the deposit flow works and how node operators receive receive the ETH that they then deposit into validators. And so there's a like huge focus on the like technological understanding of various protocols that needs to happen, and it's important due diligence to do.
Are you also looking into custody, or do you get the same kind of questions from institutions on custody?
Yeah, I think custody is a big thing. We always try to not have the custody of the funds, obviously, because that's not what we focus on. Some protocols they have like a built-in delegating feature that doesn't make us have the custody, but we tend to avoid it and leave it to companies like BitGo and Fireblocks. And what we're focusing on is like integrating with like APIs and making sure that because that's what they look for. They don't want us to have the custody, but if we tell them no, we work with Fireblocks and we work with other MPC providers, and then I always think that they feel more comfortable. And just to add something that Will was saying, and to speak good about something Lido, I think was like the precursor of it. There's also not like a standardized risk rating for node operators. It takes people like Staking Rewards and Lido to look at every node operator, know their team, what do they do, which node operators have security certifications and which do not. But in many other industries, you have like a lot of like documentation and information of who the node operators are. So I think industry is still nascent, but like it is our hope, especially in Latin America. There's still like lots of countries that have not implemented, but obviously, like in many other industries, we tend to follow the US, and I think the US is making a lot of progress that we will see in other parts of the world, like in 2-3 years from now.
Yeah, and then there's also big differences, obviously, between native staking and liquid staking, where liquid staking, yeah, there's custody in the smart contract, and on native staking, you can often delegate. What do you see is like the risk appetite from institutions for things like liquid staking, and then also going a bit into DeFi? Because, yeah, obviously, this is becoming much more important over time, and do you see blockers there from institutions on the liquid staking side, and then they're asking questions? And I guess Lido has one of the best, most permissionless stacks for liquid staking. But yeah, what are the concerns of institutions, and how do they approach liquid staking and DeFi yields?
Yeah, so I think it very much depends. Like institution is a very broad term, right? And like more crypto native, like either high net worths or like family offices that have been in the space, like are quite comfortable with liquid staking. Like about 10% of STETH, at least as of like 2 months ago when we looked at the numbers, is held by like what we would consider like institutional players. That doesn't necessarily mean they're like a traditional finance firm, but like an institution. I think increasingly, and like the DATs are a really good example of this, they are not making like significant forays with like a huge amount of their assets into liquid staking or liquid restaking in terms of at least the total percent of what they're doing initially. I think a lot of them want to get comfortable first with the concept of staking. They want to get comfortable with just like having like validators active, understand the space. What I expect increasingly, especially on that side, is like as NAV per share is kind of like below 1 right now, they're going to have to start going further along the risk curve to try and boost APR, to try and make those products more attractive. And I think liquid staking then becomes like very attractive for them. Like I'll show my own book at Lido, right? But like ST vaults where you can deposit ETH into validators, keep it just natively staked, and then mint ST ETH against that, and then go into DeFi when you want to chase opportunistic yields, to do leverage staking. I think we will eventually see more of those things become a lot more pervasive, at least on the DAT side. For more traditional institutions, I expect they will remain very, very conservative. But the problem with just normal delegated native staking is that you get locked up, right? You don't have liquidity. And right now there's a 37-day exit queue on Ethereum. Like I think that is incompatible with what institutional staking will look like. And I think liquid staking becomes a very important piece of the puzzle for them. But yeah.
Yeah, you got three main pillars for institution to be able to invest in the staking industry. You have the protocol risk. For them, it's already like months of investigations, and the reason why now they are capable of at least look at the subjects because they've been hiring developers and people that have sufficient amount of experience in the DeFi space and join some of the big institutions, or they made good acquisition, DBridge and those type of products. Then you have the operator that they need to understand, as you mentioned before, but also like some aspect of the technology that they don't grasp necessarily. For example, MEV, what does it mean? How can people collude between themselves? How can they extract value or front run those institutions? This is a big, big subject. And then the last one is the liquidity, because for them, look at the recent event from last week, there is no liquidity on the market anymore. Market makers, they suffered, if I can say. So for them, it's not something that they have experience with. So they first need to understand those three different pillars before, I believe, getting into restaking, which is actually a derivative on top of an existing product. And then they can, of course, borrow against and etc. But for them, what's important is not actually big yield, it's stability, as I mentioned before.
Yeah, I don't think there's much I can add to what you guys said. I think you put it, the idea perfectly. The more layers you add on it, you're adding more risk, and not only more risk, but because I think, for example, Lido is being audited and it's very safe, but you're adding another layer of also education that needs to happen for them to understand it. So it was natural, and I think it's going to be natural. It's already happening in Europe to have staking ETF and then try to move to liquid tokens. But it's also true that you have MEV, you have like a lot of layers of complexity that I think they need to study and understand well before they start getting into it. I also think, like Julian said, they prefer a lower yield with a lower risk, because we're talking about millions and millions of dollars. So
Billions.
Yeah, of course. And do you think institutions actually care about staking? Is this something like, do they care about how the yield is generated? Or if I think about like the staking industry, I think staking will be more and more abstracted away into general yield and financial products, because it becomes a building block with liquid staking, and this is growing. And
Yeah, it's actually a very good point. I don't think companies, B2B or big institutions actually care about staking, because staking, we believe it's a yield product. It's not. It's nothing to do with the yield product. For an institution, staking is an exposition to the risk governance and maintenance of the protocol. And if they could avoid getting exposed to that particular product, they will. What matters for them is whatever is built on top. An institution, it doesn't care if the Swift is operating or not. They just want to build something to serve the retail and sell the product. It's exactly the same. So it's a piece of technology, and they consider, I don't even, when I talk to them or we talk to them, they don't actually consider, we say yield, we used to start saying yield and staking. They don't see that as staking, as they see that as underlying technology to validate, or if they participate in that, it's just get exposed to the governance, get exposed to the risk, and it's something that they actually not have any appetite for.
so you think this is actually counterproductive to have on-chain governance and all of this stuff tied together with staking?
Well, I mean, normally they need to have on-chain governance and in order to achieve decentralization, right? But I think it's just a matter of how we sell it to institutions. If we sell it as you get yield by staking, I think this is a wrong approach. But if you then mention that you can build structured products on top or sell it, then this is actually the right way of thinking about the problem.
Yeah, I think it's an interesting point because institutions usually think about the yield, but actually it's a consensus mechanism, right? So they're having part and a vote, active vote on the protocol, and I don't think they're educated enough as of yet to make like informed decisions, like what client to run, and how does that affect decentralization of the network and so on. But I think there's still work to be done, but and there could be things that have been done on other protocols, not on Ethereum, to like delegate the vote or create like a staking proxy or like a governance proxy. That is something that we could explore in the future if, because it's also a problem if a large percentage of the staking network does not care or does not participate on governance.
What do you think will be the first DeFi products adopted by institutions? So obviously there's liquid staking, and for example, Lido, you're building the ST vaults, and like, what are the things that institutions can get comfortable with as a kind of a structured product on top of staking? Is it looping, restaking, or like?
Well,
Yeah.
I think it's already happening, like what Morpho has done with the Vault strategies. It's built, architectured, designed the same way that institutionalized traditional finance think. So for them, it's a product they understand. It's a product they can use. It makes complete sense. It's just provide liquidity, get a yield, and it can leave. I mean, it was structured and designed the same way that traditional finance work, and I think it's already happened. That's the reason why now you have a lot of attention, a lot of adoptions from institutional integration into potentially Revolut, Robinhood, or neobanks to provide yield for retail, because they understand how it works.
Yeah, I agree with that. Like, I think they've already started to sort of move into different things, right? Like, European ETPs are already staked today. Canadian ETFs are already staked today on the Ethereum side. I think that you will continue to see like more exposure to like the basic like borrow lend kind of side of the business. Leverage staking is a like fairly simple next step. Like once you get comfortable with those two things to participate in. But I would say that they're like pretty much getting involved. And in the US, like the SEC is now given some guidance on liquid staking to basically say that liquid staking is acceptable depending on how it's designed. There's still a lot of like more specific explanation that needs to come there. There's like a recent safe harbor from the US IRS regarding staking activities in ETFs that I think are going to lead to probably some pretty positive announcements in the coming months to see that really pick up in the US. But in general, like staking is already being adopted internationally pretty well.
Yeah, that's a good point. And we were just talking about the kind of the institution push, and they don't really care about governance and so on, and they just want to have like a very solid infrastructure, and staking, it's really hard to differentiate also. Do you see like there's kind of concentration risk in staking, and governance risk also? Because then if no institution cares about governance and they're all staking, then who's actually doing the governance? Is it just going to be like a centralized entity running the protocol again, or like what's actually the purpose of proof of stake, and like can this somehow integrate with the institutional side, or like is this actually a big risk for crypto?
Yeah, for sure, it's something we talked a lot about, and it's funny in a way because I remember just like a year ago, everyone was talking about the risk of Lido having like 32% of the network, and now we're talking about maybe 2 or 3 institutions having like way more than that. So yeah, I think it's something that is starting to be talked about, which is like the first step to come up with a solution. Like I don't have an actual solution, but I do know that other protocols have identified and introduced some like improvement protocols to kind of delegate that governance to like more educated or different communities that are more informed.
We had a talk yesterday, I think, or 2 days ago from Vitalik talking about the meaning of this ecosystem and this community and the vision that decentralization, privacy, and etc. Well, if you look at what happened today with X going down with Cloudflare, people could start laughing, and Web2 is pretty weak. But a couple of weeks ago, a lot of different networks were also they realized that they were controlled by AWS, right? So the problem with this community is like we tend to forget the the purpose or the vision of what we're building because of the financial aspect of the different product and different things that we are trying to achieve. But normally, if you really build it with the ethos of decentralization and privacy, you should build it for being self-resistant and having multiple different entities that can run the node, multiple different systems that can protect from being attacked from the outside or from the inside, with different layers of incentive, different layers of game theories. And I this is right, Mirko. I think right now there's a big risk of centralization across not only products that are facing retail, but also like the underlying technology that was supposed to be self-resistant, decentralized, and autonomous. And I think this is something as a community that we need to rethink. And more importantly, with privacy being attacked and AI coming into play, this is the biggest risk that this ecosystem is facing right now.
Yeah, I fully agree. And I think it's like really interesting to see actually from a staking perspective, like what's happened to the market like over the last year. Like a lot of stake has flowed into centralized players, and centralized exchanges are very, very rapidly gaining share. And it's quite interesting because centralized exchanges do not operate on chain in the way like a Lido does, but other staking protocols like a Rocket Pool too. And they can basically offer staking at very, very low to zero fee for large users, and then make money from those users with other products like derivatives. I think that there is tremendous risk as ETFs go live in the US, right? Like if BlackRock staked their entire ETF with a single provider, that would be a top 5 node operator. And some of the node operators are already top 5, kind of over 5%. We've seen the exit queue blow out already from one single large node operator kind of having an issue. And like to their credit, I think they're one of the best node operators on Ethereum. So it's quite scary from that perspective. In general, like I hope that we like find solutions and definitely like focus on supporting the protocols that are supporting the decentralization of the network. I think there's quite a few on Ethereum that do this. Those that support permissionless staking, those that support home staking, that are very much in line with the values of censorship resistance and decentralization. I think it's very, very important. And as we move more into this like institutional like focus as a community, we're definitely at risk of losing sight of that if we don't kind of like circle back and just like take an eyes wide open look at like what's happening.
Yeah, I just want to add something real quick. Like, I think if someone is going to help to find a solution, it's going to be Lido. Like, there's so much effort being done behind the scenes, and nobody sees on decentralizing how the protocol works, having operators in different geolocalizations and community staking module as well. So I think a lot of like your experience could be taken to find a solution, because this will be a problem in the near future for sure.
Yeah, I do agree, because it's like education is nice and we can all push for it and root for decentralization. That's very nice. But if the institutions in the boardroom, they're not going to care about anyone shouting decentralization, right? So there need to be tangible solutions for it. And yeah, I think what Lido is building is obviously going in the right direction. Now, we're coming slowly to an end of the panel. We're just like a lightning close, like for everyone, like what's next for institutional adoption of staking and DeFi? Like we already identified that there is a lot of adoption actually for staking, and there is even adoption already for DeFi. So we've come a very long way, but what's the next step? Like, where do we have to go? Obviously, we talked about preserving decentralization. I think that's going to be a challenge. What else? Like, what's next for the staking and DeFi and on-chain yield space to, get to the next level?
Well, you got pieces of technologies that are becoming extremely valuable for institutions to adopt this space. So secure account abstraction, secure enclave, those two technologies that were dreamed of a couple years ago, and now being into deployed into production, and this is making the adoptions of DeFi way faster than we think. Those two different technology, because you can actually place policies on behalf of users, guarantee that there is no capital being lost. I mean, from not from vulnerability, but from the bank running off with your money. So this is extremely important. You have different risk management for institution, and also what AI will be able to come into play, being able to monitor in real time the risk associated to different protocols, how the liquidity is being reused and leveraged. So I think this is making the space way stronger and also easier for institutions to adopt.
Yeah, I guess like two things from my side. With like one is packaging products that are very, very DeFi native and starting to make them a bit more like mainstream accessible is probably one. Like you touched on this with Morpho and like what they're doing with Coinbase, like that's a great example. I think the other thing from our side is very much like bringing institutions to solutions that have greater liquidity, and I think liquidity in blockchain and these ecosystems is going to become increasingly a focus for them.
And I forgot one more point. Unfortunately, I think this is something that will arrive, and this is not necessarily something we can stop, but the KYC is going to be enforced in this space. So liquidity provision involved strategy being KYC, but what we can do is like ZK KYC. So we could actually make sure that the technology is being used in such a way that we don't give our information to third-party providers like Onfido or whatever in order to verify your identity, or you can use like stuff like ZK Passport or whatsoever in order to KYC an address and being able to use it in DeFi. But I think regulations and institutions will require those type of practices in order to be able to deposit liquidity, and for their liquidity to be used by retail, they will require people to have KYC address coming into play.
I think, yeah, just to add to what Julian and Will said, I think two things that kind of go hand in hand is that on the institution side, I think they're gonna keep making an effort to make it really easy for like the retail client to stake, for example, without knowing what is happening on the back end. So people will just do a click and start earning 2.73%, and they're actually staking with node operators on the back. But at the same time, those institutions are gonna demand more from the node operators, more professionalization. I think 2 years ago, even 1 year ago, not many people had like security certifications. Now it's kind of like starting to become a standard. Also like a risk management standards. But all of this is gonna go on the back end. I don't think retail are actually gonna know all that it takes, because institutions are gonna make it really easy for the end client to just earn money and stake.
Yeah, I do agree. I think, the programmatic risk and like assurances are going to be very important. Even going to like offering fixed yield products and stuff like this, which is all very like common in TradFi already. So very exciting. I mean, there's a lot. Like we've come a very far way, but there's still like a few challenges, and also going into AI and more programmatic way, preserving decentralization. So I think there's challenges we have to overcome, but overall, very exciting space, and thanks for being here. Let's give a big round of applause.